Right. So we'll get started, brother. If you heard also one of the client, Mr. Sadhana also mentioned. So first of all, dear investors, as promised, we are back again at the start of the quarter to hear Bharat Bhai's thoughts on the macros and the portfolios. And I'm Nimesh Mehta. As always, I'll moderate your questions to Bharat Bhai towards the end. Mr. Sardana and other clients have already set the context for this session. We also spoken to Bharat Bhai. The request from the clients have been, sir, after the last call, and that we all are extremely bullish and convinced about the India opportunity. And after they heard your views on budget, all of us felt that it's a great time to increase our allocation in equities. But what I'm setting the context for the Q&A, which is going to be along today. They all feel that why is India having negative returns in 2023 despite all the good things which you keep hearing there? And unfortunately, what has also happened that our portfolios haven't done well, even when this in the last couple of months when the markets are down 5%, our portfolios are down little more than that. So if you can help us articulate your thoughts on why is this dichotomy, and second, if you can just in about 10 to 15 minutes time, share your thoughts over the last 2-3 months, macros or some developments, and more time today, 45 minutes plus time on Q&A. That will be really helpful, sir. So all over to you, Bharat Bhai, for your opening thoughts, and then we'll go for the Q&A.
Covering some of the key enabling macros, 5 minutes on that dichotomy that you talked about, and 45 minutes or 1 hour or more for the questions. So, good afternoon, everybody. Delighted to be amongst all of you. Is the subject matter context has been somebody is saying that my voice is not clear.
Yeah, there's a lot of echo in your room, sir. I think there's a lot of echo from your room, maybe because it's a very big room.
Okay, just a minute. Yeah, just a minute. We'll just check. One second.
There is an echo in your room. Yes. Give me a minute. We are just trying to sort it out.
Nimesh, is it better now?
It's slightly improved. Yeah, have you shut laptop mati band kar dena? Just close the laptop.
Yeah.
Maybe put the Polycom only on. Yeah. Maybe try speaking now.
Is it better now?
Yeah. I think anybody else also? I think this looks better. There's no echoing now. Yes, it's confirmed from Ashish Agar also. Over to you, Bharat Bhai.
Okay. Good afternoon to everybody. Last, not just 3 months, but 15 months have been very eventful since the time the war started. And therefore, if you come to think of it, over last actually more than 3 years, we have not seen any kind of normalcy around. March 20, pandemic came. The whole world went into a tailspin. Just when it looked like that the pandemic probably is behind, the second wave of the even more severe one in 2021 came. And once again, the environment got roiled. Towards the end of the year, things began to recover. And everything seemed to be headed in a right direction. And then 2022 happened. At the beginning of the year of 2022, things were looking, especially for India, compared to the rest of the world. India specifically looked fantastic. But February 2022, the war happened. We have seen supply chain disruption thereafter. We have seen raw material price aberrant inflation across commodities. And we have seen Shall I continue, Nimesh? Hello.
Well, I was checking internally if some people are saying voice is not there, but I could hear, so I was checking with. Can I just quickly take an opinion from few people on the call? Because we are able to hear, 4-5 people are able to hear quite okay. Is anybody not able to hear well? We can hear clearly.
There is an echo.
No, there is no echo now. At least there was earlier. So I think most of them are able to hear. So friends who are not able to hear, maybe just check your laptop, increase the volume and do it as loudly as I can see. Majority of the people, they are saying it's okay. So request if you can check in your system so that we can continue with that. Sorry, Bharat, I was just checking with some people if they could hear you, because I just saw people typing that we are not okay. Now it's saying okay, okay, perfectly fine. Yeah, please, Bharat.
So 2022, after the war, supply chain disruption, energy price inflation, multiple raw materials and commodity aberrant rise, corrections thereafter. China complete mismanagement of COVID and second round of supply chain disruption. And as things were beginning to kind of, in some sense, getting reconciled, then the inflation in the developed world erupted in a huge way, of a kind which has not been seen before. Germany witnessing 24% kind of inflation, which would make it look like a banana republic actually. America witnessing up to 15% inflation. Scores of European countries witness high double-digit kind of inflation. Not in decades since World War II, that kind of a picture has been seen. And clearly, I would say it is so-called developed world or the Western world, which is looking like a novice in the way affairs have been handled. Look at what has been done by Fed, the way interest rates in a jerky way have been raised in America from virtually nothing to all the way to 5.5% in a matter of just about less than a year. It would look like the management of American financial affairs is not befitting one of the most successful economies of the world. But honestly, it looks like more like a banana republic kind of an effort in a management. And therefore, the largest country in the world and arguably the most evolved, financially evolved country in the world, when it makes blunders and errors one after the other with the Fed rate rising, and then we have seen a collapse of number of banks and financial entities in America, some reverberating in Europe, more to come probably. Picture is still in a state of huge flux. It is not change, but in a flux. In the context of that, we have to appreciate that India is doing what it is doing. There is no Robinson Crusoe. All countries in some sense are linked to the others, and therefore effect in among the biggest economies of the world, which is America and Euroland, and indeed China. China actual troubles are much, much bigger than what we are seeing on the surface. And I can discuss more later in the course of the discussion. So when whole world is in a challenge, I think we have to appreciate that we still are in a very, very healthy shape. But we cannot eliminate the global troubles at a stroke of moment or with a wand of a magic. Therefore, some amount of difficulties in integrated, connected world is bound to be affecting us, and which is why in the year of 20 to 23, India final growth rate real GDP growth rate might total up to about 7%, and therefore real economic growth, nominal economic growth for the year would be closer to 12%. That number probably would have been more like 14 or 15%. And the real GDP growth rate might have been closer to 8.5%, 9%. But we have to appreciate that America, whether it will still be able to ward off recession is an open question. Europe, how less negative it will be is the question. Negativity in Europe is an assured idea. And even China, in real terms, manages to make a 3 to 4% growth. It will be significant, but I doubt whether that kind of a real, genuine number in case of China is around. It is in this context that I think the picture in India has to be evaluated. Secondly, no long-term journey, whether for a country, for a company, for markets, is ever free from its own ups and downs. There are periods when those ups and downs may be, those ups may be very pleasant. It will invariably be punctuated by periods where there'll be downs and which often may be unpleasant ones. Merits prevail over a period of time, but topicality prevails at a point of time. And topically, when there are challenges in many parts of the world, it is difficult to wish it away. But even then, in the year of 20 to 23 for India, nominal growth of about 12%. In the year of 23-24, where India's GDP in real terms will grow upwards of 6%, and nominal growth of closer to 11 to 12%, somewhere in between, still will happen. And I have no doubt whatsoever in my mind that within 5 years, two major things will happen. India would indeed be amongst the top 3 economies of the world. And indeed, India will be among the top 3 markets of the world in terms of the market capitalization. Both number 3 status as an economy, as well as number 3 status as the market, both will happen in the ensuing 5 years' time. And I think we should not underestimate the scale and the size of that opportunity and that achievement. I would very briefly, in a minute or two, will just cover finale part and would then open it to the question. There are a number of things which have happened to us as an economy over the last 8 to 9 years. And these are fundamentally very powerful changes. Reforms, when they are carried out, few and far between, and not very major ones, at best can have arithmetic sum total of effect of each reform as a final outcome. But when reforms are many, they are deep, and they are interconnected, the outcome of those reforms is not merely arithmetic sum total, but it is a geometric multiplication. And I would like to submit to all of you that what has happened in this country over the last 8 to 9 years is a fundamental redefining of the nation, her economy, her fundamental capability, enablement of the businesses, and therefore the value creation of those businesses, and therefore opportunity to profit from it as investors in these businesses. That, to my mind, remains the defining sequence and consequential outcome of this journey ahead. The changes are deep, they are not shallow. They are not for a short period, they are for a long period. The changes are not ephemeral or transactional, they are transformational. And therefore, the beneficial impact will not be for 2 years and 3 years and 5 years, but this will be for 10 years and 15 years and 20 years. That is the kind of opportunity which is staring before economy, her people, her businesses, her markets, and therefore the investors in these markets. The way we have brought down cost of capital by taming inflation, despite global inflation being high, our inflation actually continues to be lower than all the developed markets. And most of the inflation in India is external, not internal. That is a point to be noted. Cost of capital is being brought down also by fiscal discipline, current account discipline. Please remember, in the year which is disturbed, like 2022-23, with war still going on, India's exports for the year grew, not reduced, by 7%. Her services grew by 28%. And total exports of goods and services in a difficult year like this have grown by 14%. I think this is no mean achievement given the context of the world and where things have been. Therefore, cost of capital has been brought down. Our international profile has become richer. The speed at which infrastructure is being built in this country is beating all records. The adoption of the technology by not just businesses, but actually by government and the people is heralding a low-cost and scaled economy. The way the efforts are being put in to bring down the logistics cost, the way we are using digital public goods network, which is unique to the country and now acknowledged by virtually every country in the world, including standard-setting global bodies, that India's digital network of public goods, and these are not private old patented properties like Facebook and Google, but public goods being offered free of charge. It is a breathtaking experiment in what a country can do with limited resources and huge big bang impact. The way the production link incentive scheme has been rolled out, which will again take effect over 5 to 10 years, is a full potential to make a revolutionary change to manufacturing eco-space of India. The way the transparency has been brought about in taxation laws, also in distribution of public benefits, whether RERA, whether GST, whether faceless tax assessment, many of these things are heralding absolutely new kind of economic revolutions which are brewing. When you make a sum total of all of these and confidence of the entrepreneurs and the businessmen today in this country, I would say not only what we have achieved over last 20 years and 30 years as an economy or markets is noteworthy, but what we are going to achieve as an economy and as markets in next 20 years will make what has been achieved in last 20 years look very pale. And therefore, in my opinion, the most important phase of India's opportunity is begun, even though the last year in particular has been very, very challenging and difficult. So I'll stop here, Nimesh, and open it for questions.
Yeah, Bharat, I think thanks. In fact, everybody is appreciating the global and macro, and they all second. But the request from all of them has been if we can discuss portfolios. I think one of the common thing which is coming out, I'll maybe first talk about the portfolio, because at least a lot of them are IP investors, and they feel that over the last 1 year, I think our performance has been negative upwards of about 10 to 12%. and benchmark has been flat to just about little negative, so about 10 to 12% underperformance. They haven't seen this for a long time. They've been investors for long, but they are really nervous now that why is that month on month going down. It'll help if you can share why and what you look forward to the IP portfolio in the coming year.
Well, just a factual correction. It has not been going down month to month. Actually, if you look at July, August, September 22, the portfolios did exceedingly well, almost had an outperformance in 3 months of close to 9 or 10% and positive numbers. Since January, we have been more or less tracking the market. We have not done much better. Maybe we are slightly behind, but nothing noteworthy from January till now. Really speaking, year of 2022 is the year when we have suffered. Whether we have suffered compared to index, without any doubt, yes. Whether we have suffered compared to our own expectations, without any doubt, yes. Whether we have suffered compared to our history, probably yes. Because historically, each of the strategies, even though they've done resoundingly well over a long period of time, there have been some interim periods of underperformance. For example, Indian entrepreneurial portfolio, which is now into the 14th year, completed 13 years. 2022 happened to be the second year of underperformance in 13 completed years. Growth portfolio, which is 21-year-old, compounded returns at 19% plus over a 21-year period, with an alpha over index of almost 6.5% compared to index. Still, this has been the 4th year in 21-year history when there has been underperformance that we have to fight against. India Select, which is a 14-year-old portfolio, 15th running. This has been 2022 has been 3rd year of underperformance. Life, I don't know whether many of the investors in this call have that. A 15-year history, 17% compounded over 15 years with an alpha of 4.5% per annum compounded. But it is this has been a 3rd year of underperformance. So definitely we have underperformed compared to indices in 22. We have underperformed our own internal expectation. We have underperformed in some sense earlier also, but every underperformance is a painful. Without any question, we have underperformed. Whether we are doing what we need to do to recognize challenges, to recognize any problems on the portfolio, recognize external threats or limitations, in my humble opinion, we have been doing it day in, day out, because every single day is a day of battle. And we are more than anybody else probably acutely aware of that responsibility. So we are doing what we have to do. Where we think we could have improved on some of the things, we have changed it. Where we thought we made some mistakes, we have rectified them. Where we thought we needed to do a little more balancing in certain way, we have done that. And the process has not stopped. Every single day is a fresh day and we are taking a fresh look. I want to assure everybody on the call, we are not slipping on the way. Any underperformance is not to the liking, even though historically there have been other instances when it has happened. So I'm sure in any meaningful long-term investment journey for the markets, for good businesses, and for good portfolios, interim challenges, interim disturbances will come. Not that we like it, not that we invite upon ourselves, not that we are unmindful of it, but I would humbly again like to repeat that these interim challenges in a long journey will occur, whether we like it or not. In fact, if philosophically we remain on the same path, we remain disciplined soldiers of investing, we continue to do what we think is a right path for a long-term investing, then some interim periods of challenges and difficulty is inevitable in any long-term journey. That is because time to time, markets would have their own preferences. Markets would have their own likings. Some of may be very fundamentally intelligent and powerful. Some of it may be short-termish and copycat kind of behavior of the market. And good behavior, bad behavior, ugly behavior of the market will time to time happen. When markets are in a funk and in a mood of its own, it is tempting to copy the market and to do what markets are popularly pushing you to do. But I would again humbly like to submit, it is a big mistake to make. So we are watching carefully. Wherever we think we have to do what we have to do, we are doing. Wherever we thought there are infirmities, weaknesses in the portfolio, in the structure, in some names, we are addressing it. We still are at it and will continue to be at it in order to do what we think is the right thing to do. But we would not prefer to mimic and copy the market simply because it may be in a short term very tempting to do so. And therefore, please believe me, in any long-term journey, a period of this kind, however rude interruption it may appear, however heroic it may look like, however upsetting it may look like, we have to keep our minds calm and cool. We have to deal with it every day, to watch it carefully with agility, but at the same time, while keeping the mind independent and thoughtful rather than getting carried away by the sweep of the markets. Finally, I'd like to say, while results in the year of 2022 have not been gratifying, to put it mildly, if there is any one area of satisfaction, we have not flirted away from philosophy, we have not violated discipline. While some mistakes may occur, but no blunders and no foolish failures have occurred. There are no stock selection errors that we can feel ashamed about or embarrassed about. We have continued to be disciplined soldiers of investing, philosophically, discipline-wise, stock selection-wise, methods-wise. And that is something I would like to reiterate and assure everybody we will not violate again. And two important ideas which remain very dear to us, and time to time we have held it out over long periods of time to many of the investors who may have known us for a long period of time. There are two important objectives that we seek to achieve. One, over a period of time, we must get on an absolute positive basis healthy enough compounded results for the efforts that are put in on the portfolio. Second, in that long-term journey, even relative returns compared to markets or the benchmark have to turn in a superiority or what is popularly called alpha. Therefore, satisfactory absolute and superior relative, both over a period of time, is something that we remain very mindful of. We regard it as our duty. And I would like to reiterate, is something that we seek to achieve. All our endeavors at every point of time is to be disciplined students of investing, to continue to achieve those results. on an absolute basis, even if markets have not held over a meaningful period of time, we must get healthy, satisfying absolute results. And over a period of time, when purity of absolute is adhered to, relative superiority also would occur.
Bharat, if I'm reading everybody's feedback, they are saying that we are convinced, we believe, thanks for acknowledging, but could you share a little bit more sector-wise or stock-wise by which we get convinced? Have you made some changes in the IP portfolio, or are you make some changes by which should allow? So they're looking at more sectoral updates and portfolio. And then maybe I'll go a little more deeper on some stocks on Patanjali and Asian Paints question that is, but maybe broadly anything, the changes that happen which will help them to get the returns back is what they're trying to ask there.
Yeah, if you look at, for example, Indian entrepreneurial portfolio, out of 23 names in Indian entrepreneurial portfolio, as many as 15 posted positive return in 2022. Out of 15, 11 names posted better returns than the market posted, which is about closer to 3 or 4%. So as many as 11 stocks out of 23 did better than the market results. 4 names posted positive returns, but less than the markets. 3 names posted negative results and were dissatisfying despite outstanding business performance. And 5 names posted significantly negative results than what we would have thought in the year of 2022. And therefore, those 5 negative names and 3 further smaller negative names actually neutralize the positive results of the 15 names and converted net outcome for the portfolio to -5 or -6% for the year. Now, which are the 5 names which have given us maximum trouble in 2022? Tata Consultancy, surprisingly, but it fell down very sharply in 2022 from the peak. It dropped almost about 30%. Company like Divi's Laboratory did exceedingly well before that, but in the course of the year, it lost and its erosion has continued in the 2023 by a dramatic 40% from the peak it touched. Metropolis Healthcare again caused very, very unpleasant results. Sona BLW, specialty auto company, auto parts company, one of the globally recognized, one of the globally well-regarded firms in that area, but suffered very bad result. And Dixon Technology, India's largest EMS company, electronics manufacturing service provider company, aiming to be one of the largest in the world. But unfortunately, 2022 and 2023, 3 months have not turned out good for Dixon. These 5 names, if you see, common part has been good balance sheet, healthy return on capital employed, healthy return on equity, typically debt-free balance sheet, large amount of cash on the balance sheet, well-regarded management, general belief about long-term growth opportunity, because the still businesses are addressing meaningfully large opportunity which is unfolding before us. Other than TCS, definitely the other 4 have large space for growing over a period of time. TCS probably, I would say, is a growth opportunity of maybe more modest, at maybe anywhere from 8 to 12% per annum time. 2021, all of this business benefited immensely from COVID. Divi's got special order from Pfizer, COVID-related drug. Metropolis got a new line of business, COVID testing revenue. Likewise, all businesses gained immensely in 21, these 5 businesses. And their prices went up disproportionately high. 2022, reverse happened, where these businesses looked like suffering compared to 2021 in terms of their business performance, because some of the COVID-related benefit went away. The core businesses have generally continued to go along well, but COVID-related benefit went away. Therefore, business performance looked weaker compared to 21, but the price fell far more dramatically compared to what relative reduction in the result compared to 21. And therefore, unfortunately, we've been caught in that whiplash in 2022 in these 5 names. When in retrospect, when I think about it, without any question, honestly, I believe we could have done some corrective action earlier, where we could have reduced some of the position, where we were making enormously healthy gains in some of those names. And some names, at least 2 names out of the 5, definitely I feel we could have corrected earlier. We could have brought down the weight, where we could have taken significant gains home. And that would have given us opportunity actually to pile up on those companies today when prices look far more reasonable. But having suffered, we are unable to really take advantage of that today. But it's not as if any of these businesses are rubbish businesses or rotten businesses or businesses which have been poorly managed with poor management, poor balance sheet, none of those kind. Despite these are some of the most leading businesses in their respective activities, but with my head bowed, I have to accept 2022 has been very cruel for these things. And we have suffered, we have taken our lesson. Wherever we have to bring down the weight, taken corrective action, we have done it already. Some more are in offing. We have replaced it with a greater weight to the businesses that we think is a greater opportunity. Some new names have been introduced in order to counterweigh these challenges well, where we think the opportunity is greater. So many of the actions have been taken. Some more actions are in work in progress and likely to happen. But overall, it has been very sobering here. I have to accept that it is a period which very clearly has reminded us of some of the points that we should have noted.
I think, Bharat, as I read, people have been appreciating the candid answer of underperforming. You gave us some glimpse of what didn't do well. There are now a bit questions specific to some stocks, which they have still a bit of anxiety. The question on, as I read, in not in order, but Patanjali's corporate governance has been raised as a question because they couldn't complete the public shareholding to up to about 25%. So what's your thought about that? If you can, and then I'll take the second question.
Actually, it's an irony, but Patanjali actually should be applauded for governance. Let me tell you why. Some of the perception probably is linked to the company that they took over. And the company that they took over is Ruchi Soya. Ruchi Soya basically was in the business of soya-based health products, very well regarded actually in that area, and very large, second largest market share in the country in edible oil. These were the 2 principal businesses of Ruchi Soya. Management of Ruchi Soya, capable one, because they built it to the size. But in terms of governance, definitely questionable. And therefore, Ruchi Soya came to the shape where a lot of borrowings came up on the balance sheet and they were struggling to repay. And the company was foundering. All these misdemeanors were applicable to the area and to the time before Patanjali Ayurveda actually took it over. Therefore, governance-related misconception or governance-related failures, both are actually in the period prior to Patanjali Ayurveda taking it over, not really after they took it over. After they've taken it over, they've added 3 more businesses actually to the portfolio and made the business much more diversified rather than only largely edible oil driven. Edible oil still remains a large part of the turnover, of the total turnover, but in terms of profitability, clearly other businesses are becoming bigger and larger. These 3 activities have been aided actually by the new management of Patanjali. Entire borrowing has been repaid. There is 0 debt on the balance sheet. In fact, by the latest account, Patanjali balance sheet has 3,800 crore of cash on hand on the balance sheet. On the 2 pointers towards actually why they should be applauded with the governance. One, if you know, in 2021, Patanjali transferred a business of biscuits, noodles, breakfast cereals, which was having a turnover of close to 850 crores, with the operating profit of close to 160 crores. Such a significant business was shifted to Ruchi Soya at a price of mere 150 crores. Virtually, it was gifted away for free, where Patanjali private entity transferred 850 crore branded business for a price of 150 crore. Second, such a gift occurred in 2022, when a business of almost 4,300 crores, which consisted of various juices, amla, aloe vera, giloy juice, and many other specialty juices that they are known for. Ghee, where Patanjali ghee is a market leader with 70% market share. Some such businesses, honey, which is a very successful 2nd largest brand in the country. These businesses, 4,300 crore turnover, 700 odd crore of operating profit. Such a business was shifted away at a price of 625 crore. Again, it was virtually a gift. Therefore, in terms of governance, I do not know of any company that I know of which have shifted their own private businesses at such a throwaway kind of a price. By even most reasonable market value, that 4,300 crore business couldn't have been shifted at a price less than, I would say, 10,000-12,000 crores. But it was given away for 625 odd crores. And that earlier 850 crore business would definitely have fetched at least 2,000 crore kind of valuation, but was given away at 150 odd crores. One final point on their freeze of the shares because of the need to comply with 74% maximum promoter holding, 25.1% minimum public holding rule. They clearly they were late on that. It's a technical kind of issue, I would say. They would have achieved it by December 22, which was the deadline. But market conditions were so difficult and rough that doing it at that point of time was practically getting to be challenging. Therefore, they've deferred. But in my opinion, the preparations are underway. Things are being planned, and there are dialogues which are going on. I believe by June or latest by July, the remaining 6% stake that they have to offload will be achieved. And therefore, the technical compliance to bring down the shareholding of the promoter to 74% or below will be achieved by that time. But clearly, they've also learned their lesson. They were late in that. They could have probably done it earlier, but since the follow-on public offer had happened in March, doing it in August, September would have been little too early. By the time of December, things had become very difficult, but they've learned their lessons. But I would not describe it as governance lapse. Definitely, tighter management would be a better description.
So just to support what Bharat Bhai is saying, the Patanjali board has released a press release also and committing that over the next 3 months' time, they will be meeting the norms of reducing increasing the public shareholding to 25%. So that's there. Bharat Bhai, if I again sum up the question which I'm reading now, all they're saying that how will the portfolio recover? They are asking a few questions on stocks like Asian Paints. Will it be able to catch up and deliver when competition? I am also reading names of Page Industries. Somebody's written on Bajaj Finance and also Sona. So all they're saying is that how will this company which we have made, how will they able to recover and deliver it? Yeah.
See, water finds its own level. Value finds its own price. There are no special efforts we need to do. There is no special thing we need to do to get that outcome. Ultimately, markets are too intelligent. Markets are too knowledgeable. Markets are too smart. Me or my team, we remain humble servants of the market. Markets, over a period of time, remain all-knowing, omnipotent, omniscient, I would say. Therefore, we don't need to do anything special in order to find out sudden magic formula where results will start improving. The 3-4 names that you took. Asian Paints came down to 1100 in the year of 2020. Prior to that, it was at a price of some 1800, 1900. It came down to 1100, 1200. Bajaj Finance in February 2020 was 4750. It came down to price of 1750 in a matter of few months. The Page Industry, I distinctly remember prior to pandemic was at a price of 22,000. Came down to as low as 13 to 14,000 in the pandemic time. Same Page Industry, from 14,000 that it came down to, and it was 22,000 before pandemic. Today is at closer to 37,000. At a peak it touched few months back 55,000. So from 55,000 it has corrected to 37,000 in last few months. But from pre-pandemic time, when it was 21,000, it is still 37,000 today. Pre-pandemic time, when Asian Paint was 1800, today it is still 2775, 2800. Though few months back, Asian Paints touched 3500. So from 3500, it has come down to 2800. But compared to where it was pre-pandemic, it is still from 1800, it is at 2800. Bajaj Finance, which was 4,750 before pandemic, came down to 1,750, went all the way to 8,000 few months back. Today it is at 58 or 5,900. Definitely lower than 8,000 that it touched 6 months back. 6 or 8 months back, but still higher than what it was at a pre-pandemic level. Ultimately, if this business is performed, they deliver cash flows. They continue to deliver healthy return on capital employed. They deliver healthy growth of the business. and they continue to manage with integrity and governance the way these companies have done, the price is a slave and it will follow. Eventually, price will be an outcome of that growth of the business, the growth of the cash flow, the quality of growth through return on capital employed and return on equity. What we need to do is to be mindful and watch whether Asian Paints will continue to grow or not, whether Bajaj Finance will continue to deliver on healthy ROA and ROE and superior growth, whether any of these businesses that you name will continue to deliver healthy results over a period of time. Last 1 year has been disturbed, but Bajaj Finance actually delivered the best ever results in qualitative terms in September 2022 quarter, followed by even superior results in terms of return on asset and return on equity, highest ever in the history of Bajaj Finance in December 22 quarter. So we are mindful, we are aware that the prices for these businesses have corrected from the peak. Page industry, for example, delivered the best ever result in the history of that company in September 22. And June 22 also was second best performance by page industry ever. December in the quarter results relatively look weaker, and they look weaker compared to December 21 because December 21 also happened to be a good quarter. Therefore, in comparison, it looked weaker. I would say March also compared to March 22 will look weaker. March 23 top line will be lower than March 22. Margins in March 22 were the highest ever, and therefore margin also will be lower compared to March 22. Therefore, March 23 also will witness some amount of softness in the results. And markets are grappling with that. Markets are recognizant of that challenge, and therefore some softness in the price which has prevailed. So after the September result, price touch or just before September result, price touch 55,000, and today 7 months down the line it is at 37,000. Therefore, market in my opinion is already reflecting that anticipated pain. If our judgment is right, as we see, hopefully from after a quarter or so, these results will once again look like significant or material growth compared to the past. For Page in particular, Bajaj Finance, we continue to believe will record healthy growth. Asian Paints will record reasonable growth thereafter. They've also suffered on the raw material account because the raw material prices went haywire. But these are first-class businesses, very well run, outstanding return on capital employed, long-term path of growth, great character of management. And I would say valuations in the overall context, these businesses are actually reasonably priced. These are not challenged valuations in our opinion. And therefore, we continue to remain hopeful. We continue to watch. We don't want to assume anything unnecessarily. We continue to watch. But our humble belief is that these businesses are slated for many, many years of compounding.
But a lot of people feel listening to you that we may do a top up or something. The question is that if we top up, will you buy the same stocks is what they're saying there. And within that, the question is there, PI industries have suffered, Astral, Aarti industries have suffered, and some of the chemical names have suffered now. So will you again buy the same? Is it a wait and watch, or is there what is the rationale behind your investing into these names?
Aarti industry we will not buy, that is for sure. Aarti industry results have been less than satisfying. Though problems are not within the firm, problems have been outside. I would say materially, well, results have been affected. it will probably be not fair to blame the management for it, because internally they are doing many right things. But circumstantially for them, some of the things have changed externally. One of the large contracts with buyer that they've entered for a 10-year period, due to buyer having a problem, that is buyer AG of Germany, they had to withdraw that contract, and therefore the results for RT also have suffered because they built capacity around it, and they built some more businesses around it, and therefore they've suffered. So RT we are not looking at buying. But PI industry, actually, if you look at it, has done resoundingly well. If you look at it in the year of 2021-22, it has been the best period of performance by PI industry in its history. And over last 12 years, PI industry has been one of the top 10 value creators in the entire market. We've been owning PI industry for more than a dozen years now. Even in 2023, till December, 9 months, results of PI industry have been very, very healthy. Price at a peak touch about 3,675. Price today, I think, is at about 3,050, 3,075. So it is down about 17-18% from the peak. Whether I'm happy, of course, I'm not happy about it. But it's not as if PI industry has suffered any huge thing. The business has done well. Their order book continues to be very healthy. They are sitting on an order book of 2.1 billion euros even today. And they continue to be one of the finest agrochem specialty firms in the country, very research driven, top quality balance sheet, top quality management, great customer relationship, and terrific value creation record. And even fundamental results of the business continue to be quite strong. So I would say PI industry, we have no reason to kind of stay away from. But RT industry, we are not looking at buying, for sure.
As I was saying,
some of the other businesses, we will buy because we continue to believe that they are good. If we believe that they are good, and if the prices have come down, and if we don't buy, we'll be doing injustice to your portfolio. And therefore, we have to fight hard. Markets are trying to put us into its own terms. We are trying to fight with the markets on our own terms. So far, markets have been prevailing over us, but at some stage, as is the ups and downs of the history of the markets and the fluctuating waves of the market, at some stage, hopefully soon enough, the game will turn in our favor. And when it turns in favor, it comes in droves, not in ripples. And it comes without any prior intimation. It doesn't give an early warning. It just happens. Therefore, we are watchful, we are agile. At the same time, we want to remain reasonably believer about what we think are good things. We don't want to be overconfident. We don't want to be certainly arrogant about what we know. At the same time, it is our duty to remain watchful and careful and skeptical where need be. So it's a better of good blend of skepticism and belief that we are trying to weave in.
Although I missed asking DVs, and I just suddenly got a lot of people typing, ask DVs also. Would you continue to have the same view on DVs as well? Because that has suffered a lot and impacted.
DVs, honestly speaking, I don't have entirely complete answer right now to give, because I don't have a complete answer today. If you look at long-term history of DVs, it is one of the finest API, active pharmaceutical ingredient makers in the world, largest of course in India, but one of the biggest in the world. Consistently very profitable because it does cutting edge work, it doesn't do commodity work. Therefore, the margins are high, the return on capital employed is high. Their strength of the relationship with the client is also high because they do specialty work. They don't do commodity work. So therefore, many levers are in favor of DBs. Their business model is right. They don't compete with the customers. They work as the background partner of the innovator firm, which is the right business model, which keeps risk reduced. At the same time, yet continues to give them healthy reward for their innovation capability, complex chemistry capability. So DB's business model, capability, record, size, capital efficiency, balance sheet strength, all are in favor. What has not worked in last 6 months in particular, and I suspect it will be there for at least 6 more months, if not longer. In the year of 2021, they had a fantastic one-time lottery. Now, in hindsight, it is one-time lottery. At that time, it did not look like a one-time one, but a big lottery in form of a Pfizer business for original drug on COVID. COVID was raging. That drug would have done wonderfully well. Pfizer placed a firm order, and they made huge money hand over shoulders, kind of big money in that business. 2022, pandemic receded. Pfizer's vaccine also didn't prove to be all that good. General opportunity reduced. Pfizer's business got withdrawn. Divi's business got affected. For the year of 2022, Divi's top line fell by 10%, bottom line fell by 10% compared to 21, and therefore results were underwhelming. Also, along with that, the core business, the continuing long-term core business also turned little softer with the supply chain management challenges, some of the raw material related issues, some of the client order related troubles, because almost 95% of their business is international, and almost half of that comes from America, and the other half comes from Europe. So these geographies have been troubled in their own way, and some impact came on their core businesses. And therefore, that business has not grown as efficiently as one would have expected. Some softness is likely to prevail is our judgment for next 6 months to 9 months. Therefore, I don't know in the short run, how long will business performance remain in a softer territory. But if I take a view from a 3-year perspective, I definitely believe it will continue to be on a long-term growth trajectory of about 20% plus kind of growth in the top line, and probably 20 to 25% growth on the bottom line year after year. But we do have some amount of challenge in fully comprehending next 6 or 9 months. Even the management itself is grappling with that because it is coming from the environment. Price in the meanwhile has suffered a significant damage. Our portfolio also has suffered, and Divi's is definitely one name when in retrospect, I think at a price of 4,500, 4,700, we could have brought down the position to half. I remain suitably chastened to realize that we didn't do it at that point of time. Well, I can give you reasons, but those reasons will look silly. So I'll not give reasons. I accept that we could have done it, but we didn't do it at that point of time. So we are hopefully a little wiser with the knock that we have suffered on that.
Yeah. Another question, brother, I'm summing up, which will be a lot of questions on stocks are coming together, which sums up in this question. How much weight do we put or provide to valuation in our decision making? Reason for asking the question is because we have a lot of companies which are very high valuation. So how do you decide on valuation? And that's the question by Ishan at some time back.
Valuation is a very complex and detailed subject. I don't think in these limited edition dialogue with a very evolved, complex subject like valuation, I can do a full justice. And whether you will feel it satisfying that you got a reasonable answer. But let me make an attempt. First of all, what valuation is not? Let me answer that. Price earning multiple is a popular way to judge. Price to book for finance businesses is a popular way to judge valuation. Very popular, but very defective, very deficient way to value. What is a good way to value? Good way to value is to look at the future, look at the size of opportunity, look at likely profits, figure out likely growth of those profits, how much of the profit will convert into cash flow, and how long it will prevail, with what kind of capital efficiency. These are some of the questions you try to answer. That will give you a hint about likely future positive incremental cash flow, which using time value of money you can bring to the present and arrive at a value. Now that is a realistic and in terms of appropriateness, the most effective and sensible way to value a business. But then it requires answering many questions about future. By definition, future is some degree of uncertainty and some degree of variability and some degree of our own incapability to fully judge the future. And therefore, any assumption about future would have some variability invariably associated. The way we try to address that variability, time to time, we keep refining that opinion of the future that we have with the new data, new facts, new insights, new learnings. We keep redefining. Therefore, value is not some gospel truth. It's not one number arrived at cast in stone. Any good investing will demand constant refining, re-refining of the opinion on value with an open mind, with agility, with an objective approach rather than egoistic, stubborn approach. Hopefully, we are doing that. But let me put it this way: that many things that look expensive, if you plot it over a 10-year and 20-year, if the implication is what is expensive should give low return or no return, you will be surprised that if you plot the chart for 20 years, what have been expensive throughout 20 years turned out to be among the highest return givers. Not that I'm saying what is expensive in PE terms necessarily is a right thing to do, but it is because the underlying value is strong, which incidentally reflects as a high PE. Equally, many mediocre businesses, many poor quality businesses, which are abounding, more than 70-80% of the businesses in the entire market are of this kind. They quoted a single digit price earning multiple, not 1 year or 2 years, but years together. And yet, when you plot the chart and you believe that low PE should lead to higher return, you may find that actually not only they give low return, but zero return or negative return even after 10 years, 12 years, 14 years. Therefore, PE, which is substitution for cheapness or expensiveness, I like to submit is a deficient measurement. Better way to do it is by judging the value. And value many times may look like higher P, but so long as your judgment on value is right, your mathematics behind value judgment is right, even if that P may look little on a higher side, still will give you satisfactory results. So we are constantly engaged in that task.
Sure. Thanks, Bharat. One more, I'm just reading. Somebody said that you demonstrated a lot of confidence in the portfolio. Can we say that in the next 3 years, IP portfolio will be at all-time high? Sorry, stupid, tough, but you think?
Well, whether it will be higher than the earlier high, certainly. If it doesn't happen, I'll be very, very disappointed and very cut up with myself. Definitely, it will be has to be higher than the previous high it has touched. But I would expect it to be doing better than that. Let me reiterate for whatever it is worth, and I'm not trying to claim any browning points. I think there is some intermittent noise. Can you mute the rest of the thing? Yeah. So over 13 completed years of IP and 14th year running, IP is compounded at almost 18%. And it is given an alpha of almost about 6.5, 7% compared to index per annum compounded. Whether we can replicate that kind of a compounding at 18% and 6% plus kind of alpha, it will not be wise or prudent or ethical for me to make that kind of a statement. It will be rather unfair for me to say that. But whether we'll get healthy absolute return, double-digit return over a period of time, certainly it is our duty to get. Whether it will produce a meaningful alpha compared to index over these future period, certainly it is our endeavor and it is our duty to do. And therefore, a difficult year or difficult year and a half has not taken any enthusiasm of ours, any belief of ours as to what our duty, our dharma, what we have to attain and what we have to do with the right process, with the right selection, right discipline, right philosophy, and doing in a right way. We do not want to do some short-term things in order to feel that we'll try to catch up. In fact, most short-term gambits usually end up in more tears, and therefore we will not like to submit to the short-term kind of gimmicks. But we continuously want to ensure that our stock selection remains on the right side, our understanding of the business remains on the right side, the valuation is in our favor, that it continues to do what it has to do. Overall portfolio risk balancing, risk control is healthy and efficient. That overall character of the portfolio continues to be what we wanted to see. And wherever our any weakness, infirmity creeps in, to ruthlessly weed it out, that remains our duty, that remains our dharma. That has been the case over last 21 years, and it will be the case with us for the next 21 years.
Thank you, Bharat. I think we'll take one or two questions and maybe we'll stop here. There are a lot of questions, clients. It's not that we don't take. I'm giving my email address and I'll just type it here for the benefit of all and just type it there on many things which you want to ask. We will personally get in touch with you. I'm typing here. You can send it to me, which we can reach out. My colleagues locally will be reaching out. There are two email addresses which I'm posting here, which you can put across here and try and answer. Just the last question, by the way, sorry I missed out. Maybe a lot of people are saying I'm trying to avoid the question on Metropolis and we are not asking question on Metropolis there. So sorry, I'm bringing that question.
What is there to avoid? Metropolis is a good business, good diagnostics, second largest diagnostics firm in the country next to Dr. Lal. Dr. Lal is a very healthy and well-run diagnostic chain. So is Metropolis. Both have healthy return on capital employed, healthy balance sheet, decent management, clean balance sheet, no debt on the, no real debt on the books. On a long term, the growth drivers, both for Dr. Lal and Metropolis, continue to be a large diagnostic opportunity. India is still, from a health perspective, a lot of miles and a lot of long way to go. Most of the diagnostics are more, reactive, in a sense that when somebody has a problem, there is a checking done and diagnosis done. But in the international market, a large part of the diagnosis is actually preventive. That means it is done when there is no disease or a problem, but generally to maintain good health and find out where there are issues. So given the overall growth of the country, given the overall growth of the health infrastructure, given the relative under penetration of many of these services than what they should be. A healthy 11-12% kind of long-term compounded growth of the core business will happen simply as a growth of the industry. Apart from that, almost about 80% of the industry is still mom and pop kind of outfits, or rather, not even well-run mom and pop kind of outfits. And not just in Mofussil area, but even in urban areas, you find them. And therefore, from unorganized or semi-organized to better quality organized player like Metropolis or Dr. Lal is another big opportunity. Plus, all of them are they expanding their network. They are putting more because they have not penetrated all geographies, all areas. So there are many growth drivers. I would say on a long term, the opportunity to compound at the rate of 15% plus is very, very realistic. In 2021, it benefited hugely from completely new opportunity, COVID testing. In 2022, that opportunity virtually went away. And therefore, their combined results of non-COVID and COVID revenue clearly look much lower than 2021. But it is not as if their core business is being taken away. Though there is competition from some of the digital entities, Tata One, MG, and others, but even they, on a long term, have to grow the business, and therefore pricing and other tactics in a short term are not long term prevalent issues. But that said, we have reduced the exposure to the name. Very clearly, we recognize that somehow the growth in the underlying business in last 6-8 months for the entire diagnostic industry, somehow after the COVID, most people don't seem to be going even for normal checking for a strange reason which is not clear. And therefore, the business results have been weaker. That is bothering us as well. But we have reduced the exposure because of that. And if required, we may eliminate it also. But as of the moment, we have materially reduced the exposure.
Again, thanks, brother, for the candid answer. On behalf of all, I think I have shared my email addresses to each one of you. There is a customer experience email address which is received by each one of you for this webinar login. You may write back on those with questions. What we'll do is that personally reach out to you, each one of you, and try and answer your questions. There is no intent to ever not ask questions or not answer any questions. To the best of ability in the time, we have tried to answer it there, but we wish to answer each of those. And if you missed out, it's our apology to do that. But I ensure that we will personally reach back to you and answer as many. Just to further come up, Bharat Bhai has done quarter on quarter. Now, again, we met him on 3rd February. We met him today at 11th April. By the end of another 1.5 months, we'll have each portfolio manager. So there are questions. I'm sorry I couldn't take up on India Select. I couldn't take up on FOP. And I take responsibility there because everything could have been done. And therefore, each of these portfolio managers will engage with you, which will only and only discuss on stocks and sectors. Bharat has covered the macros, broader opportunity in India and in our portfolios. He's been humble enough to accept that, and we acknowledge that it's been a really tough last 6-8 months. Not a happy situation for us. But let me tell you that the efforts are very high in understanding whether we have taken anything wrong or if there are any corrections. We're doing all the corrections, but we are very, very confident that over the next course of a year or two, our kind of portfolio should do well. We thank you for your patience for all this while. We request a little more patience for this year. And I think all of what your questions should be answered once we again meet Bharat Bhai, maybe in the September quarter, maybe again in October. We meet again in June. I'm not denying that, June or July. But again, when we meet, a lot of this, what we have seen, probably would have got answered. We request your patience for the next couple of quarters, the results to do there. And on that note, if Bharat, you want to end something with your comment, otherwise we'll just thank you for your patience and end there. Over to you, Bharat.
Yeah. No, while you were talking, I was just reading some of the questions. Somebody mentioned that individual portfolio managers were going to talk last time also, you had mentioned. Surely it will happen. Each of the portfolio managers will indeed speak with you. So Nimesh is what he has mentioned earlier as well as now. We have full intent and full commitment to make it happen. Somebody also raised the question on DMart. I was reading whether it is too expensive and whether we bought it at very expensive price. Valuation again, I think, will be a little debatable area. Certainly, whether it is cheap, no. To be truthful, it is not particularly cheap. But I would say size of opportunity is so large, and it will continue for such a long period of time. In the context of that, what they've carved out is an excellent business, very, very strong business. And therefore, that remains a guiding beacon of an opportunity. Whether we have bought it at too high a price, probably not. I mean, our overall price purchase has not been very deviant one. But it has so far not done any meaningful justice to us in terms of returns giving. We recognize that it's an exceptionally strong business, well executed. But, in every business, we have some questions about which we don't have ready answers, or even managements don't have ready answers. For example, in DMart, the core business is grocery. Then there is other business which is non-grocery, where textile, clothes, other material. Their grocery business is a low margin business, but their other business, which may be 20-25% of the turnover, but margins are much higher there. For some strange reason, even though even non-grocery products of DMart are sold at very value prices, like grocery sold at very value prices, for some strange reason, for more than a year, non-grocery part of the business of DMart is not picked up, and it is affecting improvement in their margins. While they are continuing to invest into expanding the business, putting up new stores. New stores are all typically 50,000 square feet plus, and therefore it is consuming capital, taking some time. Margins are also not improving as much as one would have liked to see with the non-grocery business picking up. So there have been some challenges. Management also is little nonplussed as to why non-grocery business is not picking up well. So there, each business throws some mystery, some challenges. We try to grapple in understanding the answers. We try to find most of the answers, but some answers probably get revealed over time and not immediately. So we have to accept that markets have their own view at a point of time, and we have to bow before it and respectfully accept. But it's a great business, very, very good management, long opportunity, decades of opportunity for performance and growth. Therefore, I would still, at this juncture, our view is to be patient with it. Good businesses are so few that it is tempting in challenging time to throw them away. But then good businesses are very, very difficult to get back into. And when they suddenly get back in currency, nobody knows. You can't really pinpoint the time. So I'll request some more patience. We are watching DMart. We love that business. We are aware of the challenges. We'll continue to observe. That said, just now somebody is talking about Reliance. I would, again, it's a bit of a puzzle. Their retail business is doing exceedingly well. It is the largest retail business in the country, still growing at a healthy 20% plus kind of a growth rate with healthy ROCE. Their telecom business is a cash throwing machine with a large business of that kind, almost quarterly profit of 4.5 to 5,000 crores. But for some strange reason, why the Jio is not raising telecom prices is something that beats me. So in every business, I said some things remain unanswered, something remains a mystery. Why Jio is not letting? It's actually Jio and Bharti Airtel. Vodafone is actually struggling to survive still, and BSNL hardly counts as a competition. Therefore, game is between the two players, Jio and Airtel, and it is in each one's interest to raise the price. Airtel wants to raise price, but somehow Jio is not increasing the price. And in a competitive business, if your bigger competitor doesn't raise the price, Airtel is a challenge in raising price. So both are suffering in the process. Otherwise, the profit growth can become 40-50% rather than more modest 15 to 20%. That's a bit of a challenge we are working through. So Reliance is they unbundle their business, Geo, as well as retail. I think a good part of the value unlocking hopefully will occur. But Geo, Reliance stock returns in last 1 year have been underwhelming for sure. Last thing I would like to say, I would like to say what I repeated at the earlier part. We remain very cognizant of our duty. Whether 2022 has not been a very happy year, certainly it is not a very happy year. It has not delivered results as to our liking. Whether we have taken it lightly, absolutely without any question, no. We in any portfolio, in any best of the situations, even in the best returns in a particular period, nothing will work with a clockwork precision like a mathematical situation. By given shade, over a period of time, we will, if we get 70-75% of the judgments right, and 20-25% not so right, we still will be delivering very healthy outcomes. Therefore, every time, perpetually, we remain dissatisfied with ourselves. We continue to find more faults with ourselves than you have found with me today. Internally, we tend to find even greater fault with our own selves. Because we remain somewhat dissatisfied that more could have been done, this could have been done better. But in perspective, in any long-term journey, best investment journey in the world, it remains a probabilistic art and science. The art and science is to optimize the returns, or optimize, in other words, minimize the risk so that overall character of the portfolio comes through and delivers the results. We are not hankering for the highest, but optimally risk controlled way what is sustainable. We are not looking for fastest, but again, what is healthy without accidents. And what we are looking for is not a 100-meter race, but a 26-mile marathon. That is our mindset. And that is the mindset with which we are driving. If we get 70-75% of the judgments materially right, overall, let me tell you, both on an absolute basis will deliver healthy, satisfying results, and on a relative compared to benchmarks, satisfactory. There will, in any such a long-term journey, there'll be periods of angst, there'll be periods of excitement, there'll be periods of worry and depression, there'll be periods of great ebullient dance and joy. But through these ups and downs, neither we want to get too excited, nor we want to get defeated, neither we want to get too very confident, nor we want to be defeated. We have to continue with intensity, the task that is there, continue to find good businesses, ensure that we buy them at sensible prices so that there is a margin of safety when we buy them. Ensure that the portfolio risk is whatever we can understand, comprehend is covered. Continue to observe, maintain it in a healthy way. It is like gardening. Time to time, you have to water the plants. At times, you have to put the nutrient. At times, you have to remove the underbelly and put some fertilizer. Some plants may get weeded out. Some new plants get added. Some pruning will go on. Portfolio is exactly like that. It's like gardening. And we continue. Overall garden is to look healthy, which is the task we are engaged in. And I remain as excited, as expectant. In fact, I believe, as I said earlier, next 10, 15, 20 years, it's not next 2, 3, 5 years, but 10, 15, 20 years of huge opportunity in this country. So I remain childlike with excitement about that opportunity, and we'll get our due share. Even though at times you may have a reason to feel upset with us, like 2022, but I assure you, on a long term, you'll find enough reasons to feel good about this dialogue at some stage in future. I hope so.
On that note, Bharat, thank you for this session. And investors, we meet again with Bharat Bhai in the first fortnight of July month. And we'll send you the details of the fund manager calls in the month of end of May. Once this quarterly results are over, we will have the fund manager calls as well, where we deep dive into each of the stocks. And also I would like to highlight that in the last week, we have sent you a 2-pager note on each of the stocks your portfolio holds. So have a look at that, and we'll discuss more in detail with the fund managers end of May. Thank you all for your time.
Oh, namaste to everybody. And also please know, I have and my team members have enough skin in the game. Our own significant money is invested in ASK portfolios. Very large part of money is invested. So in a way, we are our self-critics as well. Please bear in mind. But we remain in a right way optimistic about the future.
So we all eat the same food we cook. It's not the difference. Yeah. So thank you. Somebody, I'm just ending. We trust you. Somebody mentioned that last. And thank you for your trust. We meet again. Thank you. Bye.
Bye, everybody.